In this video, we're going to do kind of like an ETF mutual fund showdown, talk about active funds and all this stuff that is really important for your portfolio and for your wealth over time. We're going to be looking at some pros and cons of the structure of some of the most popular funds. Funds like VTI or VTSAX or VOO or VFIAX. If you've heard of any of these, I mean, there are a ton. Then you probably should know the difference between QQQ and VOOG and what the heck is all of this and who the heck is John Bogle. So I'll talk about this stuff in this video, but the main reason is I was going to do this really awesome kind of comparison of the different funds, which ones I can't say recommend, but which ones I use, and some kind of historical data. But I realized like there's some really missing kind of educational level content that I want to make sure you know before we do that video, talking about funds like VOO or VTI, VTSAX. And look, I'm a big fan of passive investing, at least for the majority of my investments. So I still buy the dip, right? You can see I'm actively buying things and mostly buying. I'm not doing a lot of selling. I buy undervalued companies that I believe in. But look, I know the data. I know that on average, I have a 95% better shot of just buying certain index funds and kind of just holding them for the long run instead of trying to curate things and time the market. Plus, there's also better tax savings. So when I buy funds instead of actual individual stocks and sell them, these funds I hold on to, they have long-term capital gains. And active managers, if you buy a fund that has active managing into it, or just you trying to buy and sell, you're probably going to start getting those higher taxes, those higher income taxes, because you might hold it for less than a year. So what I try to do is I go against my urges of trying to really time the market. I'll play the game, I'll buy the dip, I'll buy what I think has massive opportunity and massive potential. I'll buy what people I think are underrating, like Tesla when I bought it originally at $40 per share. I'll buy what, I think that people are panicking around. I'll buy things that, if there's blood in the streets, that's when I start buying. That's when I started buying a lot of these holdings in my portfolio during the 2020 COVID downturn. But what I do is for the majority of my investments, I try to hold them into ETFs. So that is something that I try to do my best at. But around 1/3 of it is for me to kind of speculate and try to play the game a little bit. Now, before we get into this, look, this is an important video. This is not a video that's going to get a ton of views, right? If I made a video on making crazy amounts of money with Dogecoin and YOLOing options and doing all this crazy leverage stuff, I would get more views. But this is important, okay? These are some of the things that the algorithm doesn't like, so I rely on you to click like on this video so we can help more people see more of this content, which is actually important for their wealth and has helped me build a pretty significant portfolio now. So let's go to the basics. The funds that we're going to look at today are all going to be mirroring the market. So what this means is that they track an index, right? These are passive funds that we're going to talk about today. They're not looking to beat the market. They're looking to mirror the market. They're not actively managed. They're cheap to own in terms of fees. They make it just really easy to build wealth. And there's a ton of data on why they're really valuable to have as part of the portfolio. So let's kind of talk about some of the basics. You might have heard words like mutual funds, and maybe you're scared of the word mutual fund. You don't need to be scared of that word. It doesn't mean it's bad. I'll explain. Or ETF. And really what we're going to be talking about is we're actually grouping together mutual funds and ETFs as long as they're index-based, meaning they're tracking an index. And the opposite of this would be an actively managed fund. Okay, an actively managed fund, a popular one could be like ARK Invest, right? They have actively managed funds where they're buying and selling. They are trying to make specific topics like, hey, look, we're interested in autonomy or genomics, but actively managed tries to beat the benchmark, outperforms the average, which sounds good, right? Sounds great, but the data shows that on average it does not. The next thing, so the strategy of the index fund or mutual fund, as long as it's, or ETF, is essentially that it buys all or represents a sample of stocks or bonds in the index it's tracking. That's literally how it gives you those results, is it buys the same fund, the same stocks that it sees to track. The risk is involved with whatever it's buying, obviously. The tax efficiency is usually distributes fewer taxable gains because the portfolio manager trades less, right? It's passive. Whereas you could be paying more in taxes with an active manager, or if you're the one actively buying and selling. So what are these ETFs? Now, the most popular ones are probably the total stock market ETF. This is Vanguard's. Vanguard is a company that runs these funds that I mostly am buying. VTI. This is the total stock market. Literally what it does is it mirrors the performance of the entire US total stock market. There's large, mid, and small cap companies. It's passive. The fund remains fully invested, so there's no cash on the side. You have all the growth, low expenses, and it has an expense ratio of 0.03%. So this has a risk potential of 4, right? And remember, this risk gauge is based on bonds, fixed income, things like that too. So even though this is the total stock market, it still has a lot of volatility, but it is incredibly diversified compared to if you were just going to go all in on GameStop or, have a handful of stocks. Because what this does is it actually has a ton. It has 3,755 total stocks in the fund, and it holds 22% of the entire holdings are from the top 10 largest companies: Apple, Microsoft, Amazon, Alphabet. These companies are all market cap weighted, so it holds more of the ones that have higher market caps in the fund. But look at this, it has massive diversity here. So that's great, right? It gives us some sort of balance, right? If, for example, we have another turn down and maybe consumer discretionary items goes down, well, guess what? We have some consumer staples that people need to pay for, like toilet paper, which is going to probably do just fine. So that is a really diverse portfolio. But a lot of you guys might be thinking, okay, ETFs are good, mutual funds are bad. There's also mutual funds that are pretty much the same thing. Low cost total stock market index fund. This is VTSAX. If you've heard this around, this is probably the most thrown around index fund on YouTube, VTSAX. And what this is it's a large blend of companies. What it is, you'll see something interesting here. It holds 3,755 stocks. Does that sound familiar? Well, here's VTI, right? It holds the exact same stocks. And the thing with this is all that VTSAX is compared to VTI, you can see I'm going back and forth here, looks pretty darn similar, is that VTI is an ETF and VTSAX is a mutual fund. They both have low expense ratios. VTSAX has a slightly higher expense ratio, but both of them basically do the same thing. They track the total stock market. So when people talk about VTI or VTSAX, there are some benefits to one over the other, mostly in terms of the structure of what it is. So when we talk about index funds, we could be talking about VTI, VTSAX as the total stock market, or things can be more narrow. So VOO is something I hold a lot of. This is the S&P 500. So instead of 3,755 stocks, guess what? It is the top 500 or so in the S&P 500. The top companies, and this is VOO. It also has a mutual fund version, which is VFIAX. This is the same thing, okay? There's a very insignificant difference in terms of the expense ratio being 0.01% higher. For reference, that's $1 more for every $10,000 you invest. It's not a big deal. So there are also more specific types you can talk about. You can get into QQQ, which is just the Nasdaq's 100 largest non-financial companies. So really, if you're into technology, and then you can go into growth companies like the Vanguard S&P 500 Growth ETF, which is VOOG, which is basically the growth stocks in the S&P 500. So we're talking about companies that maybe have higher multiples, that have a lot of room to grow, maybe in terms of technology, and they're not usually the value companies that have those dividends that have been around for a while, right? So there's potentially more risk in there, but with more risk, maybe there's more growth. In the next video, we're going to talk about the actual data of which ones do better. So make sure to subscribe, as we're going to look at historical data. We're going to be looking at what happens during certain kinds of recessions. What should you do with your actual fund? So I recommend no financial advice because I can't say that. All I can recommend is that you subscribe so you don't miss that out. So all of this kind of comes from this dude named John Bogle. So man, just if you're getting confused over like VTI and VTSAX and VOO and VFIAX, you're probably going to get confused over this dude, John Bogle, who if you read anywhere, you might see him as Jack, right? Watch Jack's story. Like Jack, John, are they two different guys? Are they twins? Same dude, just want you to know. So this is basically the founder of Vanguard, and he's much more than that. He is the ultimate dude that Warren Buffett actually said, hey, Jack Bogle did more for any individual investor than anyone he's ever known. Kind of intense. So who's this John C. Bogle, Jack Bogle dude? He's an American investor, yada yada, but his biggest thing is he's credited with creating the first index fund. Now when we talk about index funds, you're probably mostly thinking ETFs, exchange traded funds, and there is a difference. So if you buy the exchange traded fund version of VTI, so you're buying VTI instead of VTSAX, there are some differences. VTI is an exchange traded fund, which means it's literally on the exchange like any other stock. You can go right now on Robinhood, Webull, whatever you want, and buy VTI. You can't do that with VTSAX. You can't. The way VTSAX works is it's a mutual fund. You have a minimum investment, and the way that you buy is you put in your order, and at market close, that's the price you pay. Same thing with when you sell. You cannot sell now. Let's say a bomb hits the White House. You cannot sell your mutual fund, even if it's during trading hours, because you have to wait till the end. But that's okay, because everyone else had to wait till the end as well. So I think I got to check on that. But that's how it works. You're not able to get out. So ETFs have some benefits in terms of they are just easy to buy and sell, transparent. There's real-time pricing. There's low expense ratios. The mutual funds, why would you buy, VTSAX instead of VTI? Well, you feel special, right? You can also automate your investing with some automatic payments that can go straight into that mutual fund every week if you want. You can start to do this now on certain platforms with ETFs or even stocks as well. It's called recurring purchases on Robinhood. But here's the thing, they have identical returns, right? They have identical dividends, and they have pretty much identical expense ratios. So anything that you buy from Vanguard is kind of known for having low expense ratios and low fees. And why does that matter? Well, the reason why, Warren Buffett is a huge fan of these kinds of index funds is because of the fees. So he told his trustee that when he passes away to put 10% of the cash in short-term bonds, and guess what? 90% in a very low cost S&P 500 index with Vanguard. So he's literally talking about probably putting it into VOO, the S&P 500 index, or VFIAX if there's some sort of benefit as a huge shareholder. So why is he doing that? Well, fees, dude. Fees are insane. Fees are killers, and they're hard to really wrap your head around because the human mind has a hard time understanding exponential gain. And so as things compound, it's very hard for the human to be like, if you put 1 penny and you double it every day for a month, how much money are you going to have? It's very hard for humans to guess that. They're off by multiples of 1,000 times and more. It's insane. So the SEC, who is basically in charge of making sure that you don't scam people, the Securities and Exchange Commission, made famous by maybe Wolf on Wall Street, is all about educating the public. And so they had to make this like fees and expenses kind of ratio and show what happens, even if you just have small fees of like 0.25% or 0.5% or 1%, what actually happens to your money. And it's pretty insane. There's a calculator by nerdwallet.com if you want to kind of Google this, but man, things can get expensive. Let's say you put $1,000 in, right? And that's it. Let's just keep things easy. You put $1,000 in for 30 years and you're just chilling. We're going to put a rate of return of 8%. And let's say the expense ratio is 2%. 2% is what I've seen Bank of America, Merrill Lynch charge, because they charged us until I realized what the heck. And years ago, I realized how crazy these kind of expense ratios. So let me calculate this. All right. So we end with a value of $5,743. Sounds nice, right? $5,700 from a $1,000 investment. Guess what the ending gross value would have been? 10,000. We would have spent $4,319 on fees, or 43% of what would have been the total, or essentially we would have nearly doubled what we had if we didn't have those fees. So literally, if you can if you want to bump this up, you can see how crazy things are and the cost of fees over time. So this is why keeping your fees low is so powerful. Also, Warren Buffett has done numerous, has embarrassed the mutual fund industry or specifically active fund managers by saying, hey, I bet you can't beat the S&P 500 over an extended period of time. Data shows that on average, people cannot consistently beat just the S&P 500. So that's why it's so powerful to have these index funds. They have incredible diversification. They're low cost. They're easy to buy into. And all of a sudden, you don't even realize, like, when you buy VTI, you own all these amazing companies. So today, we actually had great earnings from Apple. So guess what? My VTI owns a certain percent of Apple, around 2%, and we had great earnings. Great. Guess what happened with Facebook today? We had great earnings today as well with Facebook. Tesla just posted their earnings, but these things grow without me realizing, like, oh, I do own Facebook. I don't buy Facebook individually, but the fund actually holds it. So I get to benefit off of some of the holdings. So that's what those funds are and a little bit about how they work. I hope that was helpful for you. In my next video, I'm going to be comparing some of my favorites in a showdown. We're going to be comparing some of my biggest hits, some of these funds that we hold thousands of shares in, and we're going to be talking about which ones perform over time. We're going to be looking at data, and man, there are a lot, but I'm going to be breaking down the most popular ones. I'm going to hit on some of the strengths and weaknesses based on, again, data in history, and you'll get a better idea of how to actually get into this and which ones might be right for you. So now hopefully you wrapped your head around a little bit of the terminology, a little bit of the ideas of where these things come from. And in the next video, we're going to do a straight up showdown. So we're going to be talking about VOO, VTI, VTSAX, VTI, again, because I wrote it in my notes twice, VFIAX, SPY, VOOG, QQQ. I'm saying these because the YouTube algorithm actually picks up on the actual words for the rankings of these videos. Subscribe so you don't miss out on that next video. I think it's going to be helpful. I'm going to be doing all the research, and in doing the research already, I realized that I'm actually doing something a little bit wrong. I'm going to change my investment strategy. So what you see here is I'm actually going to start changing this up. In the next video, I'm going to be explaining what I've learned by doing this deep dive in data for you. So you definitely don't want to miss it. Thanks so much for watching, and I'll talk to you soon. See ya.